Imagine this. The world's largest economy, the United States, suddenly presses pause. Hundreds of thousands of government employees stay home. Federal agencies go dark. Critical reports stop being published. And yet the bills, loans, and debts of the country keep ticking. That's what happens when the U.S. government shuts down. And in 2025, as political gridlock deepens, this shutdown is now the longest in modern history, and it's not over yet. Today, let's break down exactly what a prolonged shutdown means for the economy, everyday Americans, global financial markets, and for investors and traders like you. Section 1. The Big Picture. A government shutdown happens when Congress fails to pass a budget or temporary funding bill. Without legal authority to spend money, most federal agencies must stop operating, except for essential services like the military, air traffic control, and emergency response. In the U.S., this isn't new. Since 1976, there have been over 20 shutdowns, but 2025's shutdown is different. Why? Because it comes at a fragile moment. Interest rates are high, inflation is sticky, global growth is slowing, and liquidity is already tightening. That means the impact of this shutdown is magnified. Section 2. Economic damage. According to the Congressional Budget Office, if the shutdown lasts 6 to 8 weeks, it could shave off $7 to $14 billion from GDP, roughly 0.5% of total output. Each additional week costs around $15 billion in lost growth, according to the White House. You can think of it like this. Every week, the government stays closed, the U.S. economy loses the equivalent of the entire GDP of a mid-sized country like Iceland. Here's what happens in practice. Federal workers don't get paid. Consumer spending drops. Federal contracts get suspended. Small businesses lose revenue. Public data releases stop. Investors and companies can't make informed decisions. Loan approvals, permits, and inspections freeze. Investment projects get delayed. It's a domino effect. And the longer it goes, the harder it is to restart. Even though most back pay eventually arrives, that money doesn't replace the weeks of lost consumption or business disruption. Section 3. Social and domestic impacts. Roughly 750,000 federal employees are either furloughed or working without pay. Many live paycheck to paycheck. That means rent, mortgages, car loans, and credit cards all get delayed, creating ripples in the banking system. Meanwhile, federal programs like SNAP, food assistance, and WIC, nutrition aid for women and children, face funding shortfalls. Millions of low-income families risk delays in benefits or reduced coverage. Local economies near government hubs, like Washington, D.C., Virginia, Maryland, and parts of California, slow sharply. Restaurants, transportation, and retail businesses all feel the pain. And behind the scenes, crucial but invisible services also halt. Federal research projects, national park operations, environmental monitoring, cybersecurity defenses. The system keeps running, but weaker, like a machine missing key gears. Section 4. Liquidity and financial markets. Now let's talk about the part that directly affects traders and investors: liquidity. When the government shuts down, money stops flowing smoothly through the system. Here's how: Treasury operations slow down. The Treasury General Account, TGA, the government's main cash account, becomes unstable. When the government delays spending, bank reserves fall, draining liquidity from the financial system. Repo markets tighten the short-term lending market, where banks and funds borrow cash overnight, can experience stress, just like in 2019's repo crisis. Data blackouts, economic reports such as employment, CPI, and retail sales get delayed. Traders lose visibility, and uncertainty spikes. Investor sentiment turns risk-off institutions, move capital toward safer assets. Treasury bills, gold, the dollar, and away from equities, tech, and crypto. That's why, during prolonged shutdowns, You often see volatility rise even if fundamentals haven't changed, because liquidity confidence disappears. Section 5. How markets react. Historically, short shutdowns have little long-term effect on stocks, but this time is different because of context. High interest rates, liquidity stress, global slowdown, and already elevated valuations. If the shutdown extends another month, the S&P 500 could see a 5 to 8% pullback as investors hedge uncertainty. Bond yields may fluctuate wildly as traders price in delayed payments. Crypto markets, especially Bitcoin and Ethereum, could experience temporary weakness as liquidity shifts toward safety. Paradoxically, however, deep fear often creates future opportunity once liquidity returns. Section 6. Impact on traders and investors. For professional traders, this environment means one thing: adapt or bleed. When liquidity thins, even good setups fail. Price swings become choppier. Stop losses get hit more often. So what should traders do? Reduce position size. Treat this as a storm period. Smaller size, same rules. Avoid over-leveraged trades. Margin calls and whipsaws can destroy accounts faster than usual. Respect uncertainty. If macro data is missing, skip trades that depend on those releases. Stay cash flexible. Liquidity is king. Keep reserves ready for when volatility settles. For long-term investors, these periods are often when the best entries appear. A 10% correction in panic can offer a lifetime opportunity if your fundamentals are solid. Focus on assets that can survive low liquidity environments, strong balance sheets, consistent cash flow, and deep market depth. Section 7. Global consequences. The U.S. shutdown doesn't just hurt America. It sends waves globally. Confidence shock. When the world's largest economy stops paying its workers, global investors question U.S. fiscal stability. Supply chain delays, customs, port inspections, and export licensing slow down, disrupting international trade. Financial contagion, liquidity. Tightening in U.S. money markets can pull dollars out of emerging markets, pressuring their currencies and bond yields. Safe haven rush. Gold, the dollar index, DXY, and short-term treasuries often rally as global money seeks safety. For example, during the 2013 and 2018 shutdowns, gold gained 4 to 6%, while small-cap equities fell 10% within a month. Section 8. Longer-term damage. Even after the government reopens, not everything recovers. Some losses are permanent. Canceled projects, disrupted contracts, lost productivity, delayed innovation. The CBO estimates that 10 to 15% of shutdown-related GDP loss is never regained. More importantly, each shutdown erodes global trust in U.S. political stability, the very foundation of the dollar's dominance. If these impasses become routine, investors will eventually demand a higher risk premium for U.S. debt, meaning higher interest rates long-term. Section 9. Scenario modeling. Let's outline 3 possible paths from here. 1. Short extension, 2 to 4 weeks. GDP impact, minus 0.1% per week. Mild volatility in stocks and crypto. Quick rebound once resolved. Strategy. Trade lightly, hold core positions, stay patient. 2. Moderate shutdown, 4 to 6 weeks. GDP loss, $7 to $11 billion. Consumer sentiment dips, treasury yields fluctuate. Crypto sees risk-off rotation. Strategy. Prioritize cash flow, hedge positions, look for discount entries. 3. Prolonged shutdown, 6 to 8+ weeks. GDP loss exceeds $14 billion. Credit spreads widen, job losses mount, consumer spending contracts. Broader risk of systemic liquidity stress. Strategy. Go defensive. Preserve liquidity. Wait for capitulation before scaling in. Section 10. What this teaches investors. Every crisis reveals one truth. Liquidity and confidence drive markets more than optimism or fear alone. When liquidity is abundant, everything rises, even bad assets. When liquidity dries up, everything falls, even good assets. That's why disciplined investors treat crises not as chaos, but as clarity. You see what truly matters. Which companies or protocols can survive without constant capital inflows? Which tokens have real utility and revenue? Which investors have patience when everyone else is panicking? Section 11, Action Plan for You. If you're an active trader or long-term investor, here's how to navigate the shutdown era smartly. 1. Maintain a liquidity buffer. Keep at least 10 to 20% of your capital in cash or equivalents. It gives you optionality when others are stuck. 2. Reduce leverage liquidity shocks. Hit leveraged positions first. Simpler portfolios outperform complex ones during stress. 3. Diversify liquidity risk. Don't just diversify by asset. Diversify by how easy it is to exit those assets. 4. Focus on fundamentals. Strong balance sheets, real-world utility, and positive cash flow will survive any shutdown or crisis. 5. Use volatility to accumulate. If panic drives markets down, scale in slowly. Use dollar-cost averaging rather than lump-sum entries. 6. Monitor key liquidity indicators. Watch repo rates, treasury balances, Fed reserve data, and VIX volatility spikes. These are your early warning signals. Section 12, The Human Element. Beyond charts and numbers, there's a human story here. Hundreds of thousands of Americans are going to work every day knowing they might not get paid for weeks. Small businesses near government centers are cutting staff. Families are skipping bills. Investors are wondering if the world's safest economy can still manage its own budget. This isn't just about politics. It's about trust. And once trust weakens, it takes years to rebuild. Section 13, Silver Linings and Opportunities. Ironically, every shutdown in history has created opportunities for those who stayed disciplined. Markets eventually rebound as soon as funding resumes. Valuations often reset lower, providing entry points for strong assets. Liquidity injections after reopenings can spark short-term rallies. For example, after the 2013 shutdown, the S&P 500 rallied 12% within 3 months. In 2019, Bitcoin doubled within 6 months of the liquidity rebound. The pattern repeats. Pain first, profit later. Section 14, Final Reflection. This shutdown is a test, not just for Washington, but for every investor watching it unfold. It tests your patience. It tests your discipline. It tests your understanding of liquidity and macro cycles. And just like every storm, it will pass. When it does, those who stayed calm, liquid, and informed will emerge stronger, holding assets others were too scared to buy. So, as the government remains shut and uncertainty rules the headlines, remember this: markets don't reward panic, they reward preparation. If you found this analysis useful, hit the like button, subscribe to JP Finance, and let me know in the comments. How are you preparing for a prolonged shutdown? Are you holding cash, or are you hunting for opportunities? Stay disciplined, stay aware, and as always, trade smart, think macro, and keep your liquidity ready.